As you know that futures are exchange traded derivative. To ensure that contracts are honored is that nobody will default. The exchange require both long and short to pay initial margin to open an account at the start of the trading. In other words, initial margin is just like good faith deposit, helping exchange to reduce default risk. Because it is quite likely that party which is facing losses might default, and taking good faith deposit or initial margin helps exchange reduce risk of default. The second most important term is mark to market. In the process of mark to market, the future exchange tracks the daily performance of each position. Is that by calculating profit and loss of each party at the day end by incorporating daily price changes. There is another term called the maintenance margin. And the maintenance margin is the lowest amount your account can reach before you need to deposit more and bring your account back to the initial margin level. Now I will explain you all these three terms with the help of an example. So here we have information about one futures contract that investor takes long position in gold futures on 10th December. Future price is 1300 per ounce. Expiry date is 15th December, just after 5 days, and the contract size is 100 ounces. And initial margin requirement is 5,000 per contract. It means that anyone who wants to take exposure in this contract needs to deposit 5,000 in his account. And they're saying that maintenance margin is 4,000 per contract. It means whenever the account value will drop below 4,000 per contract, long has to deposit enough money to bring account back to initial margin level. Now, in this table, they have provided the daily price movement of this gold futures contract. And here we will calculate daily gain and loss to see how exchange mark to market any account. As the initial margin is 5,000 per contract, so the investor takes exposure on 10 December, he and she need to deposit this 5,000. And at the end of the first trading day, which is December 11, price of the contract fell to $12.95. Since the investor has taken a long position at $1,300 per ounce, if on the next trading day, if the price of gold drops by $5, how it is going to impact? It will impact negatively on the long position. So if each contract has exposure to 100 ounces, the total gain and loss on this one contract would be minus 500 at the end of first trading day. As the account balance was 5,000 on 10th December, so you have to adjust this gain and loss by reducing the account balance. So at the end of first trading day, your account balance will decline to $4,500. Now see what happened on the second day. On the second day, price further dropped to $12.89. So now you will compare this price with the previous day's price. So the price will further drop by minus 6. Why we have taken minus 6? Because declining market prices will negatively impact long's position. So for 100 ounces, total loss would be $600. And the account balance will drop to $3,900. Now at the end of the second day, account balance has dropped below the maintenance margin level, which is $4,000 per contract. It means that you have to deposit enough money to bring account back to the initial margin level. So in the next day morning, exchange will give you a margin call, and you have to deposit $1,100 in your account to bring the account back to the initial margin level. On the third day, there was no change in price, zero impact, gain and loss. And just by adding $1,100 into the account, your total account balance would be $5,000. Now on the fourth day, there's further $1 drop in price. So on 100 ounces, total loss would be $100 and your account will drop to $4,000. $900. And on last date, further $2 drop and negative 200 on 100 ounces, and your account will close at 4,700. The process of tracking your account daily and calculating gain and loss daily by incorporating change in prices is called mark to market. What's the purpose? The purpose of mark to market is to ensure that exchange has the reserve to protect clients against default risk.